Okay, so you know that age-old advice, right? Buy and hold. Just buy and hold.
Right.
It's kind of the go-to for investors. And I guess the idea is pretty intuitive, be patient, and the market will reward you in the end.
Yeah, I mean, it's very appealing. It makes a lot of sense. And
Right.
yeah, and who doesn't want to be told just, sit back and relax?
Right, exactly. Just ride the wave and it'll all work out.
Right.
But today we're going to dig a little deeper into this idea.
Absolutely.
Can we actually predict stock market returns over these longer time horizons? And is this patience, is it really rewarded in the way we think it is? Or are we maybe oversimplifying things a bit?
Yeah, those are the big questions, I think. And that's what we're going to unpack today in this deep dive. And I think, you know, I'm really excited about the data that we have to go through here
Right.
because we're looking at a huge 119 years of
Wow.
U.S. stock market data. But we're also going to be comparing that and contrasting it with data from 20 other countries, just to give us a broader perspective as well.
So it's a truly global view.
Absolutely, yeah.
So just to give everyone listening kind of an overview, we're really looking at predictability today,
Yeah.
and the idea of whether patience really does pay off.
Yes.
And we're pulling our evidence primarily from the paper, Are Stock Returns Predictable? Rewarding Patient Investors and Powerful Binding Equilibriums.
It's a great paper. It's going to be a lot of fun
Yeah.
to go through.
Awesome. So let's jump right in.
Okay.
So when we talk about this idea of predictability and whether patience really does lead to those consistent rewards, I mean, the first thing we need to look at is how stable are these returns over different time frames, right?
Exactly. And that's what the researchers did. They actually went and looked at the variance, so how much returns kind of jump up and down over different holding periods in all these 21 countries, and figure 1 in the paper. I think this is really striking. What it shows is that in the U.S. at least, and this is for the U.S. market from 1900 to 2018, is that as you increase your holding period, so as you hold investments for longer, those actual returns become more predictable than if you were to just look at a series of one-year returns strung together.
So it sounds like you're saying that basically that time in the market actually is reducing the risk of negative returns.
It does seem that way, yes.
Okay, so that old adage of time in the market beats timing the market is kind of supported by some pretty solid data here.
It is, yeah. I mean, I think that's a really important insight for investors, right? Because often you think, well, the longer I'm invested, the more risk I'm taking on. But actually what we're seeing here is that the longer you're invested, the more predictable your returns become.
Right. So it's not just that uncertainty keeps growing as your investment period increases.
Exactly.
It actually starts to stabilize somewhat.
It does, yeah. And I think,
Which is good news for long-term investors.
yeah, I think, one of the things they point out in the paper is that if you had an investment horizon of 15 years in the U.S. market, between that time period, 1900 to 2018, you had a 95% chance
Wow.
of seeing positive returns, which is
That's pretty incredible.
very, yeah.
So this isn't just some quirk of the U.S. market, is it?
No, it's not. No, this trend of returns becoming more certain over longer periods was seen in most of the 21 countries that they looked at.
Okay.
Though, the level of certainty did vary. So, for example, the UK had a 90% confidence band, which was a bit tighter than the US, but the overall kind of direction of travel, if you like, was the same.
So the same pattern, just the exact numbers changing.
Exactly, yeah. And that's something that previous research has actually also found. So Robertson and Wright,
Okay.
way back in 2002, they also found a similar result.
And figure 2 in this paper, I think, kind of gives us another view on the same idea, doesn't it?
It does. So figure 2 looks at the variance of returns, but it compares it to a year holding period.
Okay.
So it's saying, how much does the variance change as you go from 1 year to 5 years to 10 years to 15 years?
Gotcha.
And again, it's across all those countries. And what you see when you look at that figure is that you see a clear shrinking
Okay.
of that variance as the time frame increases
Right.
in most of these countries. So in the U.S., for example, the variance over a 20-year period was about 22% lower than the variance in a single year. And in the UK, it was even more noticeable. It was about 31% lower.
Wow. That's a substantial difference.
It is, yeah.
Especially, thinking about, kind of the peace of mind that gives you as an investor.
Yeah, exactly.
And something that I thought was really interesting is that for 19 of the 21 countries that were looked at this decrease in volatility, this variance reduction,
Yeah.
it started around the 9-year mark. So it seems like there's this stabilizing effect that happens
Yeah, that's right.
around that point.
It does seem that way. Yeah, there's one really interesting exception, though,
Okay.
and that's Denmark.
Okay.
And in Denmark, The 20-year variance was only 31% of the 1-year variance. So that was
Wow.
a huge difference.
Huge decrease.
Yeah, it really emphasizes how much that patience can reduce volatility in certain markets.
Right. So while the general trend hold, it's not a one size fits all, obviously.
No, that's right.
And these findings aren't totally out of the blue either, right? They actually kind of align with some earlier research that's been done.
Yeah, absolutely. And they mentioned that in the paper that these results kind of align with what we already know about mean reversion. So the idea that stock prices tend to revert back towards their long-term average
Okay.
over time, and also this idea of variance ratio tests. So tests that look at whether the volatility of returns increases in a predictable way with the length of the investment period.
So this isn't just random fluctuations we're seeing. It's actually there's some potential predictability at work.
It does seem that way.
Okay, so just being patient can lead to those more predictable returns in terms of, reduced volatility.
Yeah,
But the next question I have is, can we actually go one step further? Can we actually predict
right.
where those returns are headed over the long run?
Yeah, that's the really interesting question.
Right, and that's where these fundamental indicators that you were mentioning come into play.
Exactly.
So let's dive into that.
Okay.
So the taper focuses on two key measures, Tobin's Q and the adjusted dividend yield.
Yes.
Let's start with Tobin's Q. Can you explain what that is and why it's important?
So Tobin's Q is essentially a ratio, and it's the ratio of the market value of all companies in the stock market to the replacement cost of their assets.
Okay.
So if you think about it the very simplistic way, it's saying, what is the market valuing these companies at versus what would it actually cost to go out and buy all of their assets and kind of rebuild them, if you like.
So if the Q is much higher than 1, does that mean the market is potentially overvalued?
Exactly. That's exactly what it means.
Okay.
It suggests that the market is maybe getting a bit ahead of itself and valuing companies more than they're actually worth. And conversely, if it's below 1, that might suggest that things are undervalued.
Gotcha.
Now, one of the challenges with Tobin's Q is that it's very difficult to measure the replacement cost of all the assets in the stock market accurately.
Right. I mean, especially things like brand reputation and intellectual property.
Exactly, exactly. You can't just go and buy that in a shop, can you?
No, you can't.
So they acknowledge that in the paper that there are these measurement challenges. And so what they do to kind of get around that is they look at deviations from the average.
Okay.
So rather than looking at the absolute number itself, they look at how much it's deviating from its long-term average.
So it's relative to its own history.
Exactly, yeah.
And what did they find when they looked at the data on this for the U.S. market?
So they plot that data in Figure 3, and this is Figure 3 in the paper, and it shows how much Tobin's Q has deviated from its average in the U.S. from 1900 to 2018. And what's really interesting is just how persistent it is. It tends to stay above or below its average for quite some time. You see these big spikes before the big crashes in 1929 and 2001 and 2008, and then subsequently falls back.
It's almost like a market thermostat getting too hot and then needing to cool off.
Yeah, that's a great analogy.
Okay, so now let's move on to the second indicator that they look at, the adjusted dividend yield, or ADY as they call it.
Yeah.
We all know about dividend yield, right? It's that annual dividend payout as a percentage of the stock price.
Right.
But what makes this adjusted dividend yield different?
So the adjusted dividend yield really tries to give us a more complete picture
Okay.
of the cash flow between investors and companies.
Okay.
So the dividend yield only looks at dividends, but the adjusted dividend yield is much more comprehensive.
Okay.
It includes not just dividends, but also stock buybacks, new shares being issued, cash that's used in M&A activity, and even private equity. So it really tries to capture all the different ways that companies are either returning capital to shareholders or taking it from them.
Right. So it's really like a better reflection of the total return to shareholders.
Yeah, and I think particularly in today's market with the prevalence of buybacks,
Right.
if
Exactly.
you just look at dividend yield, you might actually be missing quite a lot of the picture.
Absolutely. So what did they observe when they compared this more comprehensive ADY with just the standard dividend yield?
So Figure 4 in the paper shows how much both DY and ADY have deviated from their own long-term averages.
Okay.
And what you see immediately is that ADY is a lot more volatile than DY. So it jumps up and down around its average much more frequently. And the other thing that's really interesting is that in recent decades, ADY has tended to be above its long-term average, while TY has been below
Okay.
its average for quite a lot of the last sort of 40 years or so.
And that's due to the shift toward buybacks that we've been seeing.
Exactly, yeah.
Now, the paper also mentions that they actually put these indicators through some pretty rigorous statistical testing to see if they really are what they call mean reverting or
You
stationary.
do, yeah.
So basically, whether they tend to come back to their average over time.
Exactly. Yeah, and they use a couple of test unit root tests and KPSS tests, which I won't go into the detail of, but these are statistical tools for checking for stationarity.
Sure.
And the main finding from those tests was that ADY was consistently stationary across different time periods.
Okay.
However, the results for Tobin's Q were a little bit less clear-cut, especially when you look at the whole period from 1900 to 2018. And that's because Tobin's Q tends to stay high or low for extended periods.
Okay.
And so from a statistical point of view, it's harder to prove that it's truly stationary over very, very long horizons.
Gotcha. So it seems like this adjusted dividend yield might be a more reliable signal of long-term value
Yeah, potentially, yeah, I think that's what they're alluding to.
compared to the standard dividend yield or even Tobin's Q on its own.
Yeah, that's right.
So let's talk about how they combine these signals together, because
Okay.
looking at just one indicator might not tell us the whole story, right?
Okay.
So how did they put Tobin's Q and the adjusted dividend yield together in their analysis?
So they introduced figure 5 in the paper, and this plots the invert of the adjusted dividend yield, which they call IAD,
Okay.
alongside Tobin's Q, so Q. And they do that because it means that both of those ratios, when they're above 0%, they suggest poor value.
Okay.
So a high Q means prices are high relative to the underlying assets, and a high inverse ADY, which means a low actual ADY means prices are high relative to the cash being returned to shareholders.
So both of those above zero gives you that signal of potential overvaluation.
Exactly.
Yeah. Okay. So what did they see when they looked at these two together?
Well, the last 20 years have been kind of mixed
Okay.
because Tobin's Q has generally been suggesting overvaluation, so prices being high compared to the value of the underlying capital. But IAD has actually been suggesting undervaluation
Interesting.
for most of that time, except for the very last year in their data.
Okay. So one is flashing caution while the other is saying things are okay.
Yeah, it's interesting, isn't it?
Yeah. So how did they deal with that conflict in their analysis?
So their approach was to use both Q and IAD
Okay.
in their statistical modeling, which was slightly different to some of the previous research that had been done, which had combined Q with the regular ADY.
Gotcha. So they've identified these indicators that might give us some clues about long-term returns.
Yeah.
But how do they actually use them to predict returns? And this is where it gets a little bit more technical, right, with the econometrics?
It does, yeah, but I'll try and keep it as simple as possible.
Sure.
So they use these two concepts, co-integration and Granger causality,
Okay.
to really explore the relationship between these fundamentals and what happens to stock market returns in the future.
And co-integration, that sounds pretty technical.
It is, yeah.
Can you break that down for us a little bit?
So they use a really helpful analogy in the paper from Fabazzi, and they talk about a drunken person walking a dog on a leash. Now, both of those things, the drunken person and the dog, they might stumble around randomly, right? But they'll always stay relatively close to each other because of the leash.
Right, because they're connected.
Exactly, yeah. So co-integration is kind of like that leash.
Okay.
It means that even if these individual variables are kind of wandering around without a clear pattern, there's a long-term stable relationship between them that prevents them from drifting too far apart.
Gotcha. So in this case, what's the drunken man and the dog? What are we talking about?
So they're looking at things like the overall level of the stock market, so the total value of all the companies in the stock market. They're looking at the amount of dividends that are being paid out. They're looking at the amount of capital that's invested in the economy and the amount of liabilities
Okay.
or debt. And individually, all of those things, they tend to move without a fixed average.
Okay.
But the idea is that there might be one or more co-integrating relationships between them that act as that leash.
Okay. And to analyze these long-term relationships, they use something called a vector error correction model, or VECM.
That's right.
So what did their initial analysis find?
So their initial analysis using the Johansen test found evidence of one co-integrating relationship among those four key variables that we talked about.
Okay.
So that's stock market value, dividends, capital, and liabilities.
Okay.
But then what they did was they wanted to test whether Tobin's Q and the inverse ADY actually fitted into that broader framework.
And what did they find?
So the test suggested that IED was definitely part of that long-term co-integrating relationship. When they tested Q on its own, the evidence was a bit less strong, But when he tested them both together, there was very strong evidence that both Q and iety represented co-integrating relationships at the same time.
Interesting. Okay, so even though the initial test kind of suggested there might be one relationship, the paper kind of doubles down and says, no, we think there are actually two.
They do, yeah.
And now just because these indicators are co-integrated with the broader market, that doesn't automatically mean we can use them to predict future movements, right? That's where this concept of Granger causality comes in.
Exactly.
So can you explain Granger causality in a nutshell?
So Granger causality, it basically helps us to determine whether past values of one economic variable are statistically correlated with future changes in another. So it doesn't necessarily mean that one causes the other
Right.
in a real-world sense, but it does mean that there's a predictive relationship there.
Okay.
So, for example, if we find that changes in Tobin's Q consistently precede changes in stock market returns,
Okay.
then we can say that Tobin's Q Granger causes returns.
Okay, so did they find that Tobin's Q and this inverse ADY did show this predictive relationship with future returns?
They did, yes.
Okay.
So Table 7 in the paper shows the results of their VECM model. And what you see there is that there's a statistically significant negative relationship between changes in stock prices and the values of both Q and ED from the previous period.
Okay.
So what that suggests is that when those indicators are high, potentially signaling an overvalued market, future stock returns tend to be lower.
Gotcha, and vice versa.
And vice versa. Exactly. Yeah, and then Table 8, that really confirms that with a specific Granger causality test. And that shows that both iety and Q do Granger cause changes in stock prices.
Okay.
Which is a really interesting finding.
Absolutely. And they also looked at some shorter-term relationships that they observed, right?
They did, yeah.
So what did they find there?
So they found some interesting short-run Granger causality from changes in things like dividends and liabilities to stock prices. So in the short run, what they found was that an increase in dividends actually might be partially offset by a decrease in equity returns in the following period.
Okay.
Which is kind of consistent with this idea that maybe in the very short-term dividend policy doesn't really fundamentally change a company's overall value. And then they also found that increases in liabilities, so debt, tended to be followed by short-run increases in equity returns.
Okay.
Potentially reflecting, the benefits of using borrowed money to invest in the short term.
But they kind of contrast that short-term view with the longer-term relationship involving dividends, right?
Yeah, exactly.
So what did they say about that?
So in the longer term, what they found was that higher levels of dividends tended to be followed by higher returns, and that was in contrast to the short-run result.
Okay.
And they point out that historically, periods of low dividend yields compared to stock prices have often been followed by lower stock price increases over the longer term.
Interesting.
And they reference Schiller, who's done a lot of work on this, and so that suggests that dividends, despite some of the theory about them being irrelevant in the short term, might actually provide important information to investors about future prospects.
So dividends do matter.
It seems that way, yes.
So we've got this evidence now that suggests that long-term stock returns aren't completely random, and these indicators might have some predictive power. But how reliable are these predictions, really?
Yeah, good question. And so what they did in the paper was they wanted to put that to the test.
Okay.
And they compared their VECM model, so this vector error collection model, with a really simple benchmark, which was just to use the average historical return.
Okay.
And they did that over 3 different time periods, 1967 to 1986, 1987 to 2006, and 2007 to 2018.
Okay, and why did they choose those specific periods?
So they chose those periods to represent different market conditions, really.
Gotcha.
With varying levels of return. So, they wanted to see how well the model performed in different environments.
Right, makes sense. So what were their findings and what were the results?
So in terms of the in-sample forecasting results, so that's where you use all the data to build the model.
Right.
And then you see how well it predicts within that same historical period. What they found was that the VECM model generally had smaller forecast errors than using the historical average.
Okay.
And that was consistent with some other research by Campbell and Thompson, who found a similar thing.
Gotcha.
But the really interesting thing is the out-of-sample forecasting results.
Right, because that's more realistic, right?
Exactly.
Like you're only using the information you had at the time.
Exactly, yeah.
Okay, so what did they find there?
So for the out-of-sample tests, they re-estimated their VECM model each time using only the data that was available up to the point of the forecast.
Okay.
So really trying to simulate what it would be like to predict the future. And what they found was that even in this more stringent kind of set of conditions, the VECM often outperformed the historical average.
So it wasn't perfect, but it was better.
Exactly, yeah. It was certainly adding value.
Okay, so it sounds like this VECM approach that they used incorporating Tobin's Q and the inverse ADY really does have some legitimate predictive power.
Yeah, I think that's the conclusion they reached.
Okay.
And I think, their results really lend support to this idea that we can forecast long horizon expected market returns.
Yay.
It's not a futile exercise.
Awesome. And they even used their model to make a forecast for the future, didn't they?
They did, yeah.
So what was that? What did that look like?
So figure 13 in the paper shows their VECM forecast for the U.S. market from 2019 to 2040.
Wow.
And it actually predicts a bit of a downward trend in both stock prices and dividend payouts, which translates into an expected average market return that's about 1.5% lower than the historical average during that period.
That's a big projection.
It is. Yeah, it's quite significant.
Okay. So the paper also touches on something that seems pretty different. It talks about implications for price controls in the UK infrastructure sector.
It does, yeah.
So how does this research that we've been talking about tie into that?
So predictability is actually really important for regulators in the UK who set price controls for essential infrastructure, so things like utilities, water companies, energy companies, that kind of thing.
Okay.
Because they need to estimate the cost of equity capital, so essentially the return that investors expect to earn for holding shares in those companies.
Okay.
And they need to do that to ensure that they're setting fair prices for consumers and also adequate returns for investors.
Right, because no one wants their water bill to be sky high, but
Exactly.
the companies have to be able to make money too.
Exactly, yeah. It's a balancing act.
Yeah. And so how can this research help those regulators?
Well, it can help them in a couple of ways.
Okay.
So firstly, the methods that they use in this paper allow us to test whether the market is currently over or undervalued.
Okay.
Based on those two indicators, Lobin's Q and inverse ADY.
Right.
And that can give regulators an indication of whether future returns are likely to be higher or lower than historical averages. And that's a really important input for setting those price controls.
So basically, are we in a bubble? Are we in a bear market?
Exactly, yeah. Are things expensive or are they cheap?
Gotcha.
The second way it can help is that by using the VECM model, they can estimate the difference between geometric and arithmetic average returns over different time horizons. And that's a bit of a technical point,
Sure.
but it's important for regulatory calculations.
And what were some of their specific findings for the UK context?
So they looked at the difference between log returns and arithmetic returns, again, quite technical,
Right.
but they found that the VECM model actually suggested a smaller difference for longer time periods,
Okay.
so implying potentially lower volatility in the future than historical data might suggest.
Interesting.
And they also used historical UK return data to estimate the expected market return, or EMR, for a 20-year horizon.
Okay.
And their estimates came out somewhat lower than the estimates that have been used recently by UK regulators, and that was incorporating this idea of the DECM framework.
So maybe UK regulators are being a little bit too optimistic.
Potentially, yeah.
Okay. And then one other thing that they mentioned is this idea that the U.S. market might be overvalued according to their analysis of Tobin's Q. And they point out that that actually has implications for other markets like the UK.
It does, yeah.
Because those markets are closely linked. So we might expect to see lower than average returns in those markets as well.
Yeah, that's right.
For some time.
For a period of time, yeah.
Okay, so to kind of wrap this up,
Yeah.
what's the main takeaway for our listeners after this pretty deep dive into over a century's worth of data?
Well, I think the central takeaway is that long-term stock market returns are not entirely unpredictable.
Okay.
There are these fundamental indicators like Tobin's Q and this adjusted dividend yield that when you analyze them properly using sophisticated statistical models like a VECM, you can actually glean quite a lot of information.
So more than just looking at past averages.
Exactly, yeah.
Okay.
And I think it also reinforces this idea that we started with, that in most markets, being patient with your investments has historically led to more stable and more predictable returns over longer periods.
Okay, so here's a final thought for everyone listening, given this evidence that suggests there's at least some level of long-term predictability in stock market returns.
Yeah.
And considering these signals that we're seeing right now from these indicators like Tobin's Q and this adjusted dividend yield,
Yeah.
how should this influence your own long-term investing strategy? And what kind of expectations should you have for returns going forward? Is this simple buy and hold approach really always the best, or do we need to think a little bit more actively about these underlying market fundamentals?
Yeah.
And what does this projected kind of downward trend in the U.S. market mean for the broader global investment landscape?
Yeah, some really interesting questions for investors to think about.
Absolutely some food for thought.
Absolutely.
Thanks for joining me today.
Thanks for having me.
This is great.
It was a lot of fun.